Good afternoon. Ladies and gentlemen, my name is Alicia Bank. I'm an HR specialist working for the Division of Pay and Benefits. On behalf of the Division Director, Tasha Brown, I welcome all of you to this educational seminar. I would like to extend a warm welcome to those of you who are live streaming on CMS YouTube, as well as those who are viewing via VTC and audio conferencing at our regional offices and outlying offices in the field. Before we get started, I have a few administrative items to share with you. So please mute your phones to assist with noise distractions. Hold all questions until after the presentation or as directed by the presenter. For those in the audience, please use the microphone to use for questions that everyone benefits from your answers. Be sure that you sign and complete the survey questionnaire. Before you leave, please drop off the questionnaire to the benefits specialist monitoring the tables right outside. For those who are not here in person, you may email your surveys and questionnaires to the HR Center at hrcenter.helpdesk@cms.hhs.gov. If at any time you are having problems with the phones, please call the WebEx for assistance. And now, our guest speaker presenting on financial basics is Ms. Garnetta Macy. As a financial advisor, Garnetta is qualified to provide credit union members with professional assistance, quality financial products, and dependable services. Garnetta is a registered representative of CUNA Brokerage Services Incorporation, a broker-dealer with a select portfolio of securities products such as mutual funds, and a member of FERNA and SIPC. Garnetta is also licensed insurance representative of CMFG Life Insurance Company. Please join me in welcoming Garnetta.
Thank you so much. I'm really happy to be here this afternoon and welcome to Financial Planning Basics. Again, my name is Garnetta Massey, and I am the financial advisor located here at Security Plus Federal Credit Union. And so we're going to get some really good information about financial planning basics. And if I could just roll back the time a little bit, I just remember when planning, if you think about it, when I was a little girl and we wanted to go on a trip, we had to get a map to find out how to get there. But now and today, you can actually get directions right off of your smartphone, or even you can go on navigation in your car. So we're going to talk about how do we plan that and getting to a financial plan. So it's a lot that we're going to cover this afternoon, but it will be very beneficial for all of us. And just remember that financial planning is not a one-size-fits-all. So this afternoon, we're going to cover a few items here. And the ground that we're going to cover will be setting goals. It's very important that we first step to any financial planning is having a goal. And the next step, excuse me, I'm getting used to these buttons here. So we said setting goals, and the next will be budgeting. And how do we construct a budget? I get a lot of people ask me, well, how do I do a budget? So we'll get through that as well. And then we're talking about emergency funds. Well, how do I know how much to save for emergency funds? The next topic we'll talk about using credit. When is a good time to use credit? And insurance. I'm going to get used to this. And investing. We talk about investing too. We're going to touch on a little bit about investing as well. And then we're going to talk about tax planning. There's taxes that involve pre-tax and after-tax allocations. And then we're going to talk about saving for college. A lot of people ask me, when do I start saving for college? So we'll go through that as well. And the big topic, retirement planning. When should I retire? How do I get to the amount of money that I want to have when I retire? So we'll talk a little bit about that as well. And last and not least, estate planning. There are some topics that you really need to look at when you talk about financial planning. So let's talk about setting goals. That's our first one. Because the first step in any financial plan is to set goals. When you set your goals, you need to define them. And I would say to you at this very moment, kind of close your eyes a little bit and just think about what type of goals do I want to have. You may even think about paying off your credit card debt. When do I start doing that? Is that something that's far off, or is something that's going to be almost immediately? And then what about if you want to buy that new fancy car? Could that be one of your goals? How do I get there? How do I plan for that? The next could possibly be something that's a little bit farther out. Let's say you want to buy a new home or you want to build a home. How do I plan for that? That can be your goal. And the next one could possibly be, I want to start my own business. And how about if I want to retire? How do I do that? What are my plans to do that? What I suggest is that you write them down. And not just write them down and put them in a drawer. Write them down where you can look and see them every day. Put them somewhere that's very visible. Some people like to put some pictures on the refrigerator. Put your goals on the refrigerator. That's where you tend to look at sometimes. Or if you have an office, write them down, look at them. They should be relevant. They should be something that you want to do and plan for. Next, how smart are your goals? That's very, very important. Concrete, possibly, they should be concrete and focused. It's very important. So we're going to look at an acronym called SMART. And with that, we're going to look at being specific. You should really look at how to describe in detail what your goals should be. I want to save my child's college education. That sounds good, but how do you get there? Do you want to save for a 4-year college? And when do I start? You look at what college you want your child to go to. If it's hometown university, well, hometown university is going to cost me $20,000 a year. Well, how do I plan for that? You're going to be specific. Just saying I want to save for college is not specific enough. Then we need to say, is it measurable? You should track your progress and clearly know when you want to reach that goal. I want to really talk about the fact that you want to have it specifically. Some people tell me, I want to retire. Well, when do you want to retire? Put a date on it. I want to retire at 55. Well, how do I get there? What am I going to do? You need to be specific with that and also have it to be measurable. And then can it be attainable? And attainable is realistic and its reach goals can be challenging, but you should have a fair and achieving and want to achieve it. Just say it. Is it realistic? Some people tell me, I want to have $1 million when I retire. Well, how do you plan to get there? If you say I want to have $1 million in 30 years, that's more relevant, it's more realistic. And then we have to also look at the fact is that timing is very important. Put a time on your goal. You know, if you really want to retire, if you want to pay off your debt, put a time factor on it. Because anybody can say, I want to pay off my credit cards. But you need to be specific with that. And again, I recommend is that you write down and prioritize your goal. Be specific. Especially when I talk to people that are getting ready to retire, and they want to know, well, how much should I have in retirement? Look at your current income, and then think about, do I want to have 60% when I retire of my income that I have now, or do I want to have 70%? Very, very important that you be very specific. This is a great one, budgeting. We have to budget, all right? Because you really need to know how much income that you have and how many expenses that you have. So we're going to look at what type of income. And when you do your budget, look at all the income that you have. Of course, we know if we're working, like most of you out here are doing, that's your paycheck. And what other income do you have? You may have some rental property. Include that as income. Government benefits. You may be getting some type of disability, or you may be on Social Security, or whatever it may be. Look at all your income. And interest, if you're getting interest on your deposits, write that down. Investment income, look at all of your income. It's very, very important when you're doing a budget. And the next thing you want to look at is your expenses. And we have what's called fixed expenses, and we have discretionary expenses. What are your fixed expenses? Pretty much your rental income if you're renting, your mortgage, groceries, utilities, your credit card debt, any other debt that you know of that is fixed, you should write that down. Now, we do know that we have some other type of debt that we have, and that may be during the holiday. So it's not really can write that down as far as a monthly expense, but you can kind of think about how much you want to spend at the Christmas holidays or any type of holidays, whether it's birthdays or whatever. It's good to write that down, plug in a number. And what I tell people too is if you're giving gifts, you should have a set amount that you're going to give. And I say this, $25 is a great amount to be specific about when you're talking about some of your expenses. If it's not a very close person to you, $25. If it's someone very close to you and you really want to plug that in and give them a little bit more, you can look at $50. But kind of think about your expenses. And so after you get all of that written down, you're going to deduct and see, okay, now I have a surplus. I have all this money left over now that I've paid my bills. What do we do with that surplus? There's a couple of things you can do with it. You can put it into your emergency fund, or you can take that money and invest it. So you have that emergency fund keep building and building, and when it gets to a point, let's look about investing some of it. Now, what happens if there is a deficit? What do? Well, you can do one thing, change your expenses, or change your discretionary expenses. Maybe I won't go out to dinner, 3 times a week. Maybe I'll only do it 1 time a week. Or the other thing you can do, you might not like this one, you can get a second job and help pay for those expenses where you can get out of the red. That is very, very important, to get out of the red. And how do we do it? Change our expenses, change our discretionary expenses. It's doable. So we talked about the surplus, we talked about the deficit, and now here we're going to talk about emergency funds. This is very, very important. And emergency funds that is readily available to meet unexpected expenses. I hear this a lot. Miss Massey, how much should I have for my emergency expenses? It's what you're comfortable for. If you look at your expenses, and God forbid, if you lose your job, how long should I save for that? If you're in a type of job that lays off a lot, then you need to look at maybe I need to save or have emergency fund about 6 months or even to a year. If we roll back the clock a little bit, 2008, a lot of people lost their jobs and they didn't have an emergency funds. They did some tragic things because they couldn't take it. They couldn't pay their mortgage, they couldn't do a lot of things. So it's very, very important if you kind of look at your expenses, and if something were to happen, I have enough money set aside that I can use for any discretionary things that could possibly happen. And especially if you have a home, there are things that can go wrong, whether it's the hot water heater or there needs a roof. Well, what do I do? If you don't have the emergency funds, what people do? They take the plastic out. And so there where we come with the problem where your expenses can exceed your income. So when we look at emergency funds, it should be your foundation for your financial plan. That is critical. Before we start saying we want to invest, we've got to make sure that we have money set aside to take care of those things that we're not sure when it's going to happen. So it's very, very important. So the rule of thumb, of course, we can say 3 months, we can say 4 months, 5 or 6. But I like to say, let's keep emergency fund that's what's good for you. Remember I said earlier, one size doesn't fit all. You have to look at your situation. And it's not good to put your emergency fund in a jar. I'm going to go back to that. Some people like to put it on the mattress. Well, it's not going to do you any good. It's not earning anything. So you want to put it somewhere where it's easily accessible. And that means that you need to be able to tap into your emergency fund with no more than 1 to 2 business days. All right? It can be in a savings account or some type of investment where you readily can attach to it. Now we're going to talk about risk management with insurance. We talked about that a little bit, but the common insurance that you need to have, one, I'm sure everyone in here have it, you're working, so you have a health plan, so you have that. But what happens if you're in a terrible accident and you're not able to work? What happens at that point? You may be at the point where you don't have to worry about that, but it's very, very important that you do have some type of health insurance plan to take care of the doctor bills when you go to the doctors, when you need x-rays. All of those types of things are very important as we plan for a financial plan. All of these things have to come into place and to look at it. Auto insurance. I'm sure everyone here, if you're driving a car, you have auto insurance. It's very, very important because if you have an accident, you don't want to be sued. You want your insurance to take care of that for you. Then we have life insurance, which is very, very important. It's to replace your income. And I'm sure if I'm looking at everybody around here and people that's on the video, that you have some type of life insurance. If you don't, it's very, very important because if something were to happen to you, who picks up that income that's going to be lost? Well, the insurance, life insurance can do that for you. Property insurance. If you own a home, you have to have that. Things do happen. We've been having a lot of rain here. Okay, trees have been down, cars have been damaged, homes have been damaged. With property insurance, that takes care of that for you. When you're doing your financial plan, all of these items have to come into play. Same thing with liability insurance. You know, if someone hits your car or whatever, we need to make sure that you're covered. Insurance is very critical that we look at when we're doing a financial plan. Disability insurance, when you're unable to work, you need to have replacement income. Disability insurance will come and help you to do that. When you're sitting down with your financial plan, think about all of these different things that I'm talking about as far as risk management. And then we have long-term care insurance. A lot of people ask me about long-term care, and I tell them, well, you really have long-term care. It's all your assets. And if you don't have it, then you have to have the insurance for long-term care. Very, very important. As we get older, we will need some type of care. You may be fortunate to have a family member to take care of you, but if not, who helps you with that? Using credit. Well, credit's not all bad at all. It's very, very important, and when you're doing your financial plan. And we look at credit, there should be 3 C's that we look at. Capacity, character, and collateral. Those are the things that any type of company that's going to extend credit to you will look at that. So when we talk about what is credit, out the Webster Dictionary, and I'm going to read it right to you, the provision of money, goods, services with the expectation of future payment. So if someone's going to extend you credit, they expect for you to pay them back. So that's what the Webster Dictionary says. So how do your credit decide to grant you credit? Well, they're going to look at these 3 items here. Capacity. Are you able to pay that back? They're going to look at your income. Do you have income to support what credit they're going to give to you? And they look at your character, which is very, very important, because if they're going to loan you money, they want to get it back. So they're going to look at your history, your payment history. They're going to pull your credit report. And I suggest that everyone pull their credit report annually. It's very, very important things on your credit report that may not belong to you. So it's very important if you're going to get credit that they're going to look at your credit report and to make sure that you're paying on time. And it's important that you look at all 3 because all creditors do not report at the same time. That's why it's important to look at all 3 credit reports. And then we're going to look at collateral. Just like when you go out and buy that fancy car we talked about earlier, well, they're going to put a lien on that. All right, so if you do not pay your payments like you should, they will come and take that. The same thing with your mortgage. That's collateral. If you do not pay that, of course, they could have a foreclosure. So all of these things are very good when you're talking about a financial plan. You need to look at all of these things, and whoever's doing your financial plan, of course, I hope it's me, that I will ask all those questions to make sure that you are covered in all of those areas. And everybody asks me credit score. How do I get my credit score to be better? Well, let's pay your bills on time. And they're going to look at how much credit you have out there and what are your balances. And so it's very important they look at profiles of people, of course, similar to you and the debt that you have, and they come up with a formula and give you your credit score. So you really need to know what your credit score is. Believe it or not, in order to get even insurance, they look at your credit score. To get a car, they look at your credit score. And that's so important because that's going to determine what your interest rates are going to be. Higher interest rates going to take you what? Longer to pay off that debt. So those are very, very important items to consider. Remember that credit is money. So if someone's going to give you credit, they're giving you money, so to speak. And we talked about the credit report, and we talked about credit score. Now we're going to look at some debt. Using credit creates debt. And so you need to kind of look at that because as we move forward developing a financial plan, we want to look at your credit card debt. Some debts may be small, some may be very minor purchases for credit card, but it's not to say not to have debt. We need to put that into place when we're doing the financial plan. You need to look at some type of credit when we do that. There's all different types of debt. You have secured debt and you have unsecured debt. Pretty much I talked a little bit about secured debt. That means there's some collateral attached to it. Unsecured debt, they're giving you that credit based on your history, your paying ability, and that's how unsecured debt is given. Even with credit cards now, you can have a secured credit card. If you have had credit that does not look that good, then they may extend your credit card, but you're going to have to secure it with some type of deposits. So important considerations that whenever you look to do or to get loans, you really need to make sure that if it's a long-term debt or it's a monthly debt, and include that in your budgets, as I mentioned earlier. The interest rate you're charged on debt also affects the total interest that you will pay on your loan. So if you have a higher interest rate, it's going to take you much longer to pay that debt off. And it's also important to look at the term, what amount that you're going to be borrowing, and the interest rate. Very, very important. The higher your credit score, the better rate that you will probably get. Investing. Okay, we're going to talk a little bit about investing. Now that we talked about using credit card and loans for accumulating debt, let's talk about investing and the potential for accumulating growth. Do you associate investing with speculating or gambling? Or do you think of it betting on what the market will do, or you're thinking about timing the market? It's very difficult to time the market, as some people may think. Saving, yes. Are you looking for a long-term type of savings to build the future? Investing a carefully planned and prepared approach to managing your money with the goal of accumulating funds for your needs. That's very, very important. You got to make sure how we're going to invest and get the return that we're looking for. Are we looking for growth? If I had $100, do I want it to grow to $200? Or do I want to invest where I'm going to be getting some dividends, I'm going to be earning some interest from it? So there's also that type of debt as well. So we're going to look at the risks. There's always risk involved when you're investing. Understand a risk-reward trade-off, okay? You may want to say, I want to be very, very aggressive. That's okay, but then again, your risk is a lot higher. If you want to be more conservative, then your risk is a lot lower, but your return may be as low as well. So it just depends on where you are as far as your long-term goals. Because over time, it can do you better, and it also will give you opportunity for it to grow. The second key is personal tolerance for risk. And I talk to people about this all the time. If the market goes south, how do you feel in a short time? Do you say, okay, I need to change my investments, or do you stay with it? Because over time, historically, it has done better, but there are no guarantees. Ability of investment plan to deal with potential losses. How do I feel if I've lost 10%? Or can I be okay if I only lose 5%? Do you make a change, or do you stay in it for the long haul? So we're now going to look at growth, income, and stability. There are several key terms you'll need to understand when planning your investments. These three words are probably familiar with you. Growth, we pretty much know what that is. We know that we want our money to grow, and when it comes to investing, growth means that an investment has the potential to grow. It happens you might be able to sell it off or you may be able to pay for it. Then we're going to talk about income. That's when your investment will give you some dividends or will give you some interest. So some people, depending on where they are in life, they may want both. I want some growth and I also want some income. Stability. I need to have some stability. That's the third objective of investment. Refers to protecting your principal. I hear this a lot. Okay, I have this amount of money, but I need to make sure that it does not reduce my principal. So how can I get that? How can I do that? So it just depends on where you are in your investment cycle. You can do both. You can have that and as well as growth. Now we're going to talk about something about tax considerations. We have what's called pre-tax dollars and we have what's called tax-deferred dollars. With your pre-tax dollars, that's when they deduct amounts from your paycheck before they start taking out taxes, state and federal taxes. For all of you in here, you probably have or have the option to put in money into a TSP plan. So that is before taxes is taken out, which gives you a lower tax bracket. So that's a pre-tax, when we call pre-tax before it's calculated out. So the result can be lower out-of-pocket costs for you because you're paying less taxes. So the government is giving you that opportunity to be able to save for retirement if you look at pre-tax dollars. Some example can be health or dependent care, where you can able to put things into a health savings plan. You can put money there and you won't have to worry about paying taxes up front for it as long as you use it for that purpose. There's also transportation costs can also be part of pre-tax dollars. Now we're going to look at tax-deferred growth. No taxes are due until funds are withdrawn from the account. There are some type of investments where you can grow and you don't have to worry about paying taxes until you take it out. And you can look at retirement plans for that. When you take money out of your retirement plan, now is the time that you're going to pay taxes for it. But as long as it's there, it's going to earn and it's tax deferred. That is a great way to save for retirement or for education purposes. In certain cases, qualified distributions are tax-free. It depends on that type of investment. Of course, we have what's called 529 plans. That's another tax-deferred growth. If you're looking to save for colleges, there are 529s. Every state has a 529 plan. The state of Maryland has one as well. But you can go into any other state for a 529 plan. The only difference is that you won't have the tax liability. You'll have a tax liability if you go anywhere else, but you don't have to have it if you put one in a 529 here in the state of Maryland, because you can write some taxes off for that. So it gives a taxes for you to take benefit of that. You don't get a lot of information about that, but it's there for you because other states may have a better plan. And also, you also have for college, it's a prepaid for college, but that's only for the state in which the child will be going to college in. You can pay for it up front in today's dollars. So that's the way you can have a plan for that when you're doing your financial plan. I know that I'm going to have my child go here in state and I'm going to prepay it in today's dollars. I don't have to worry about it when they graduate from high school because it's already paid. Or I do a 529 plan. I can save in it. Of course, there's fees associated with it, but you don't have to worry about paying federal taxes on it as long as it's used for education purposes. So, but then I recommend that if you're going to do a 529 plan or prepaid, find out what the cost is. Start saving towards that. And you can know that by the time that child gets ready to go off to college, then most of it will be paid for because you saved for that. If it's used for education purposes, that's fine. Let's say the child that you've been saving for, they don't want to go to college. So what happens to that money? Well, you can assign it to another beneficiary to receive it. If you decide to take it, then you will be paying taxes and also a 10% penalty. So those are kinds of things when we look at pre-tax and tax-deferred growth. So those funds can grow for you and also be compounded. So that's the way to save for any type of retirement or education purposes. And also the Roth, retirement plans, traditional IRAs and Roth. That's also a tax-deferred growth as well. It's very, very important you can start saving now for that. And even if you're 50 and you haven't started, it's never too late. When you put money into the Roth, it gives you the opportunity to grow, and you don't have to pay taxes on it when you do withdraw it. There are certain things that you have to qualify for in order to do that, but it's available to you for the Roth. Traditional IRA accounts, you can save for those tax deferred, but at 70 and a half, you have to start taking withdrawal, and then that becomes a taxable event. But Roth does not, as long as you meet the certain criteria for the Roth account. Penalty tax applies in some situations, as I mentioned earlier, so it's right there at the bottom. And then I'm going to show you how taxable versus tax-deferred growth can help you. When you look at this chart there, you can see $35,565 and you can see $57,435. The difference in both of those is the fact is that if you put your money into a taxable investment, you will get a 1099 every year, and you have to claim that interest on your tax return. So if you put something in a tax-deferred type of growth, you don't have to claim anything until you make the withdrawal. As you can see in this example, $10,000 was invested in a year. They had a 6% annual growth rate. That was consistent. They were in a 28% tax rate. So that person that put it into a taxed investment, as you can see, they did not grow as well because they had to claim the taxes. So they only had $35,565. But if you put that same amount of money into a tax-deferred growth, you would have had $57,435. Now, of course, when you start to withdraw it, you're going to have to pay taxes, but you're still in a better position in the one that was taxed before. After their taxes, they still had $41,353. So you can see the difference between taxed and tax-deferred growth. And as mentioned, I talked about saving for college. That's a tax-deferred growth as well, and the potential for tax-free earnings, as long as that child is going to go to college or some type of higher education. Withdrawals not used for college is subject to tax and a penalty. I mentioned that earlier. So if that child or grandchild, whomever you're saving for, if they decide not to go and you say, okay, now it's my money, I'm going to take it, well, you can do that, but you're going to be penalized, and then you have to pay taxes on it. There's our fees and expenses when you have a 529 plan or prepaid college plan, because it's being invested. So there are some type of fees. So whenever you sit down with someone doing your financial plan, you need to make sure you understand the fee structure that's associated with both types of plans. So when does retirement start? It starts now. Don't put off planning and investing for retirement. If you have a retirement plan here, which I know you do, you want to go ahead and start saving because it's before taxes. The sooner you start, the longer your investments have a chance to grow. Playing catch up later can be difficult and expensive, but it's not the end of the world. So just let's look at this. We're going to look at putting $3,000 annually into an investment at a 6% annual growth return, and we're going to reinvest all of our earnings, and it's not going to be any taxes. So hypothetically, you could actually put $3,000 in, and we're going to look at over a certain period of time, of 20 years. So let's just say you're 20 years old, and you want to retire at 65, so you have all this time to put this money away. So if you had started earlier, guess what? You could have had $679,500 because the fact is it's tax deferred, and the point is that is over a long period of time, and you started saving. You had a goal that you want to retire at 50 or 55. In this scenario, it says 65. Well, I can walk away. I know I have almost $700,000. But let's just say you didn't start so early, okay? You started putting your $3,000 away at 35. So how much money can I possibly have if I had a continued growth rate, interest rate of 6%? You could have possibly had $254,400 when you walked out at 65. Now let's just say, remember I said it's never too late to start? And if you waited until 45 to start saving, you could have possibly accumulated $120,000. So it's the earlier gives you a better chance for your money to grow, because any type of investment, depending on what type it is, and especially if you're in the market, it's not this. It goes like this. But over time, it has tended to be a better way to invest if you have the time in which to do it, if you have the time horizon. It's very, very important. But again, $120,000 is better than zero. Now, let's look at retirement basics. And I always get this question sometimes. Well, what kind of retirement do you want to have? So before you start planning for your retirement, you need to ask yourself 3 basic questions. As I stated earlier, what kind of retirement do I want to have? When do you want to retire? How long will retirement last? This is all part of your financial planning process. So if we look at, let's go back a little bit. What kind of retirement do you want? And if you could just picture yourself right now, do you want to be laid back in a hammock, or do you want to be sitting by the pool? Do you want to travel around the world? It looks so nice, and I can get up when I get ready. I don't have to be at work at 7 or 9 o'clock. I really want to do all of this. I just want to relax and have fun. Well, how do we get there? So you need to think about, when do I start planning for this? And how much of my pre-retirement money do I need to have? So let's just say you made $100,000 while you were working. Do you need 60% of that in retirement, which will give you about 60 grand? Or do I need 70% of that, so I give you 70,000? So at this point, think about where you are right now, and if you have less than 10 years to retire, it's a good time to kind of figure out what income will I have. Now, I know we have all the government people out here, so you all pretty much know how much you may have when you retire, but will that be sufficient? Will you be able to travel around the world? What will you be able to do with that? And it's also good and important, when do you want to retire? Some people say, I'm going to retire when I'm 80, okay? So think about, when do you want to retire? What age do you want to retire? Because when you do retire, you want to be able to get up and move. And if you're 80, you may not be able to move, you may not be able to travel like you want to do that. So that's very, very important. So as we just discussed, the earlier you retire, the longer the period of time your funds will last. That is very critical. Will my money last in retirement? And as we think about it, with all the new technology and the new changes in healthcare and so forth, we could possibly live in our late 80s and all the way into 90s, and some into 100. So will my money last? Will I be able to do the same things that I'm doing today? Very, very important. So I would suggest, whenever you decide to say this is it, whether it's at 65, you need to add 25 plus years to that to give you an idea how long you'll be in retirement, and can you support your retirement lifestyle. Some people say, I want to keep the same lifestyle that I'm in. So think about that as you start doing your financial planning. So now we're going to talk a little bit about tax advantage savings vehicles. We did talk a little bit about this. Tax deferral can help your money grow for you if it's tax deferred, because it can be compounded, so it can help it grow. Take full advantage. This says 401k. I know you don't have a 401k, you have a TSP, but I suggest that you take full advantage of that, your sponsored retirement plan here. And contribute, if you can, to a traditional IRA account and a Roth. I talked about the difference between a traditional IRA and a Roth. So just because you're putting money aside in your company's retirement plan, you can still put money into a traditional IRA or Roth depending on your income bracket. But it's still a way to help support when I talked about what retirement lifestyle do I want. So that would help to take care of that by putting the money aside now. So if you should withdraw the money before a certain age, there's a 10% penalty for early withdrawals. And right now that age is 59 and a half. So if you're not 59 and a half and you start taking money from your retirement plan, you're going to be taxed 10% as well as pay taxes on that. So before you start tapping into those type of investments, that's why it's so important to have what I talked about earlier as an emergency fund. So when you need money to do certain things, that's when you tap into your emergency fund and try to keep your retirement plans intact. So when you do say, this is it, I'm out of here, you have money to take care of your lifestyle in retirement. Estate planning is another very critical part of financial planning. And I'm not going to go through it all, but it's very, very important that you think about these three items. Intestacy. If you do not have a will, the government will decide where your assets will go. And I strongly suggest, and when I sit down with members and I talk about financial planning, the first thing I ask them, do you have a will? So it's very important that we do have a will. If not, like I stated, the state will tell you where your assets will go. The other thing that you need to be concerned about when you talk about estate planning is, I said, wills. If there's a trust, you decide who you want to take care of that for you. You designate that person. I would suggest that you talk to an estate attorney, trust attorney, to do that for you. The will, even when you have a will, you may have the will, you may have a lawyer, do it for you, but you also need to register it. Just having a will and you haven't registered it, if someone were to locate and find your will, they're going to say you didn't have one because they tore it up. So it's very, very important to register your will as you also get one. So how do we do that? And also for planning for incapacity. We never know what happens in life. You could have been involved in a serious accident. It doesn't matter what age you are, things do happen. So who do you want to take care and make those decisions for you? So it's very important that we look at a health directive. That's another thing that's very, very important we don't think about. When I sit down and I talk to people about financial planning, that is one of the things I suggest is to have a health directive when we're doing your financial plan. Because you don't want other people to make those decisions for you. You need to make those decisions for yourself and make them now while you're able to do that. And I'm going to show this part about when the state will make those decisions for you if you do not have a will. And if it's a husband and wife situation and one should pass away, well, if 50% will go to that spouse and the other to the children. But that may not be what you want. So the will would designate where you want your assets to go. Especially with the fact if you have property, you really need to make sure that you take care of that. Your actual wishes are irrelevant. It doesn't matter what you want. If you didn't put it in writing, it doesn't matter. So that's why the will comes into play for you. There's many potential problems if you don't have that, but if you do, you know what you want will be taken care of. So the will is your cornerstone for your estate planning. That's it. If you talk about estate planning, the will is what you really need to do. And I know you may have heard that before, but it's really, really critical. Even today when I talk to people, they still do not have a will. And it's very easy to do, and it's not that expensive. And it directs where you want your property to be distributed, how you want it to be distributed. And you should name an executor in your will. That can be a family member or someone that's very, very close. If you have an attorney, it can be that person or whomever you can trust that would do the right thing. If there's a minor involved, you should include a guardian for that minor. And can accomplish other estate plannings to minimize your taxes. Again, as you sit down with a financial advisor, can help you with doing your financial plan that will incorporate all these things that I'm talking about. So it must be written, has to be signed by you, and it should also be witnessed as well. And I talked about incapacity. So that's very, very important because things do happen in life and we just don't know when it will happen. So there's a lot to consider when we go through this process. And you do have the workbooks. There's a lot of information that will go into detail what I talked about and covered here this afternoon. So feel free, if you have any additional questions that you want to ask me one-on-one, I'll be happy to do that for you. There were some pins out in the lobby with my business card there, because everybody's situation is different. There's no one-size-fits-all. What may be good for your friend or your family member may not be the same for you. So it's very important, if you're looking to do any of the things that I talked about, financial planning, where it involves for college education, planning for retirement, any of those things, you need to start thinking about it now, doing your financial plan, look at your debt. I tell people, get out of debt before you retire. You don't want to have that when you retire. Very, very critical. If you have a lot of credit card debt, put a date on it when you want to pay it off. Because when you put a date on it, it makes you responsible at that point, because you have it right in front of you. Look, I'm going to pay off my bills in 2 years, and how I'm going to do it, I'm going to sit down and I'm going to figure it out, or I'm going to sit down with an advisor who can help me have my plan in place that it will happen. And it can happen, but you have to be smart about it. It has to be specific and measurable, relevant, and you need to know what that is. But you're able to do it. So I just thank you all for giving me this time to sit down and talk with you about financial planning basics. If you get anything out of this seminar today, the main thing I want you to remember is get a budget, because the budget will allow you to look at all of your income and all of your expenses, and it'll let you know, do I have a surplus or am I in a deficit? If I'm in a deficit, how can I get out of this deficit? How can I come back and be in a surplus? You can do that, but it takes time. It doesn't happen overnight, because guess what? You didn't get in debt overnight. So it's going to take time to get out. So if you have that surplus, what do we do with it? You can put it into your emergency fund, and then once you decide what is a good emergency fund for you, the excess can be invested. So those are the kinds of things I like for you to take away from this seminar. And again, I'm available right now, moderator. You may open up the lines for questions, and I will try to answer your questions. Any questions in the audience? I don't think I did that great of a job. There has to be some questions out there. Yes. How do you register? You go to the Register of Wills. To the Register of Wills. That's how you register. Go to the Register of Wills. Any other questions? I think this gentleman wearing the purple shirt, did you have a question? I saw your hand go up. Okay. Yes, sir. Can you come to the mic so I can hear you?
So for a 529, is going out of state basically the equivalent of not going to college?
No, that's not right.
No.
Going out of state 529, it may be a better 529 out of state.
No, I'm saying if you're in state from Maryland, your child decides to go to Virginia or Arizona or wherever, can those funds in that 529 go to paying for that college?
Yes, it can go anywhere. Yes.
Okay.
Yes. The only one that you have to go in state would be prepaid. Prepaid is normally in the state in which you live.
Okay.
All right. So if in today's dollars, that you can actually pay for your child's college education. Let's say if you wanted to go into the state of Maryland, it would be here. But 529 can go to any college anywhere in the United States.
Okay.
Mm-hmm.
Hello.
Hi. How are you?
Okay, thank you. You recommended getting copies of your credit report pulled,
Yes.
but I'm a member of Credit Karma. Do I still need to do that annually?
That's fine that you're a member of that, but you need to make sure that you look at all three. I don't know if they allow you to get all three reports. If they do, that's fine, but you can get them annually at no cost. I do think you may be paying a fee for that service. Do you pay a fee for that service? Okay, well, great. So, but do you look at all three credit reports, or are you just looking at one, or they just let you know there's a problem?
They let me know there's a problem, but I do see two of the three reporting companies of what they have on me, so I'll pull the third one.
And are they correct? Okay, good. And you should do it annually, because there's no fee. You can do it annually, but I would get all three.
Okay.
Because things do happen with all the technology that we have today. Anything is possible, identity theft, those things can happen. So that's why I strongly recommend that. And not so much, you also should look at your credit score as well. I would suggest that, because you need to know when the credit score determines a lot of how you get extended credit, how you get credit, and they look at that. So you should really know. And if your credit score is not where you want it to be, you need to find out, what do I need to do to increase my credit score, okay?
Yeah, they provide the credit score also, though.
I'm sorry?
They also provide your credit score.
Well, great. So you're happy with that, I would assume. Good. Congratulations. Any other questions? Well, the only thing I would suggest, you do have the handout there that we gave you, the workbook, and pretty much what I talked about this afternoon is included. Not everything, but it gives you an idea of some of the things that you should probably pay attention to that will help you in that financial planning process. And it's just very, very important. I don't care what you're planning for, whether, like I stated, if you want to retire, or you want to save for your children's education, or you want to buy the big house. Some people tell me they retire, especially, I'm sorry, men, but some of the men want to buy these sports cars, and I think that's a wonderful thing, because that's a goal, that's what you want. Well, how do I do that when I retire, or do I need to plan for that? Include those expenses when you're doing the budget. And how is that going to look when I do retire? Because when you retire, you want your expenses to be lower than what they are while you're working, because at that point, you own a set income, all right? Of course, we know that we can go out and get more income, because we can go and do what? We can go get another job, but we don't want to do that. You remember, as I talked about, how do you want your retirement to look? You want to close your eyes, and you want to think about, I want to lay out on the beach, or I want to be in my hammock, or I want to be able to take care of my grandchildren. That's probably not one of them, but whatever that you're looking to do, you have to plan for it. You really have to start planning now. Now's a good time. And as I said earlier, it's never too late. We just have to do it. So if there are no more questions, we did finish up a little bit earlier. Yes, sir.
I have a question. When you were talking about the investment, the one tax deferred versus the one that you pay taxes, I was thinking about an IRA that is the traditional and the Roth. Can you elaborate how that affects the investment in based on what you just indicated?
Okay, when you look at tax deferred, and you're talking about IRAs, you're talking about a traditional, and you're talking about a Roth. Okay, your traditional IRA, that you can put money into that. Right now, I believe the maximum you can put in is $5,500. If you're over 50, it bumps you up $1,000. So you can put about $6,500 into your traditional IRA account. Now, with the traditional IRA account, when you turn 70 and a half, you have to start making withdrawals. The government will tell you how much you have to take out. And it's very, very important that you do that, because if not, you're taxed on the amount that you should have at 50%. So you really need to make sure if you have a traditional IRA account. Now, for the Roth IRA, you can put money into that as well. And of course, with the Roth, there is no set time frame when you have to take it out. Now, the earnings in that are you don't have to pay taxes on it as long as you meet some criteria. All right, you don't have to claim the earnings for federal taxes. You will have to pay state taxes, but you would not have to pay federal taxes. So the Roth is a nice way to start to supplementing your retirement income, okay? But the traditional IRA account, even with your TSP, if you roll it over to a traditional IRA account, and you can do that, but you still will have to start taking withdrawal at 70 and a half.
When you're talking about that, how much that will be the mandated withdrawal?
I'm sorry, say it again?
How much when you say I have to start taking money out of the IRA at 70 and
a half, yes.
how much is,
How much you have to take out?
Right.
That's a very good question. There's a formula that the government has set up. At each age bracket, there's a certain percentage that you will have to take out. And let's say the last time I looked, and I may not be exactly right, but estimate, I think it was like 27.3. So you take that number and you divide it into the previous year, when you turn 70 and a half, what your balance was on 12/31. All right? But you don't have to be that concerned about it, just the fact that you know you have to pay it, because wherever you have the money invested, they will let you know what your RMD is required, what's required. And your RMD is just required minimum distribution. That's what RMD stands for, required minimum distribution. So wherever you have your funds invested, they normally tell you what the dollar amount that you have to take out. Every year, excuse me, that percentage will go down as you get older, but you still have to take your RMD, and you don't want to be penalized. If the institution, wherever you have your funds at, if they have not given you that information, you should call them, because they will let you know what you have to take out. And every year it's going to be different. Okay?
I have a quick question. I know you always hear the age 70 and a half, but if you are still working, do you have to start withdrawing your money?
Yes.
If you're 70 and a half, you do. Now, here's another question. Is it the April after the year that you turn 70 and a half that you actually have to
Yes, it just
withdraw?
depends on when you turn to 70 and a half,
Okay,
yes.
So that if, for instance, if you turn
If you-
70 and a half this year...
This year, you can have until April of 2019.
Okay. good.
Yes. But always confirm your RMD with whomever, wherever you have your money invested, because they will tell you how much you'll have to take out. Okay? Any other questions? So now there's no more questions. Seems like everybody's ready to do a financial plan and get started. And whatever those goals are, it is a good time to start. It really is. And so I would strongly suggest that you look at those things. And since the questions were about, retirement, I get 70 and a half, and do I do a traditional RA or Roth RA, that tells me that you're thinking about retirement is a little bit more closer than it was before. So that means we need to start thinking about, well, how do I get to where I want to be if I only have 5 years before retirement, or 10, even 15, okay? Because 15, I know I got time. I can put my money away, and it's going to be tax deferred, okay? And I don't have to worry about it. So I can think about now, I know I'm going to need X number of dollars in retirement, even though you may get a pension here, but that may be just for your expenses. But what about the play money? Okay, that's what you can be thinking about for investing outside of your retirement plans that you currently have. So I think this is a good time to start looking at those things. And again, please look at the workbook. There's a lot of good information in there. I'm available, and it's no fee to talk with me. I can talk to you all day and all night. It's not going to cost you nothing. So please feel free to give me a call, and I'll be more than happy again to answer your questions. Sometimes people have questions that's more personal, and I'll be more than happy. I'll be standing out here a while if you want to ask something that is really related to you as opposed to the group. I'll be more than happy to address that question for you. And again, I think I had some business cards out there. Feel free to call me, and I will answer your questions directly. Again, thank you so much for your time and allowing me to come here. I really do appreciate it. And I hope you all got something from this event. If you take away one thing, that's good enough. Thank you again.
Before closing, I'd like to say thank you to all of those that attended, and be looking out for some future announcements of the upcoming seminars. Thank you.